The spinning top candlestick pattern plays a significant role in trading by highlighting moments of indecision within the market. It is characterized by its small body situated between long upper and lower wicks. This formation suggests that neither buyers nor sellers have gained significant ground over the other, despite activity on both sides. The presence of a spinning top in a chart can signal that the current trend may be losing its strength or that a reversal might be forthcoming, making it a valuable tool for predicting shifts in market direction. Traders are encouraged to practice identifying and interpreting the spinning top within their trading setups. By doing so, they can develop a deeper understanding of market sentiment and enhance their decision-making process. It is essential to note, however, that like all technical analysis tools, the spinning top should not be used in isolation. Traders should consider other indicators and contextual market insights to make well-informed decisions. Finally, it is important to remember that the world of trading is dynamic and ever-changing. Continuous learning, practice, and adaptation are crucial for staying ahead. Engaging with the markets, refining one's strategies, and staying updated with the latest analysis techniques, including the study of candlestick patterns like the spinning top, are integral steps in the journey of a successful trader. Candlestick patterns play a crucial role in technical analysis, serving as a visual representation of market sentiment and price movements over specific time frames. These patterns are formed by the combination of opening, closing, high, and low prices for each time period. They provide traders and investors with insights into potential market directions, enabling them to make more informed decisions. One key pattern among these is the hammer, recognized as a bullish reversal indicator. The hammer pattern typically forms at the bottom of a downtrend, suggesting that the market could be nearing a turning point. It is characterized by a small body at the upper end of the trading range, with a long lower shadow and little to no upper shadow. This shape resembles a hammer, hence its name. The small body indicates that there was little movement from open to close during the period, while the long lower shadow signifies that sellers drove prices down, but buyers were able to push it back up, closing the period near the opening price. This dynamic hints at buying pressure and a potential reversal of the downtrend. The appearance of a hammer pattern is considered a signal that the market may be bottoming out, suggesting that it could be an opportune time for investors to consider entering long positions. However, it is important to wait for confirmation through additional indicators or subsequent price action to validate the potential reversal. Traders often look for a higher closing price on the next trading day as confirmation that the bullish reversal is underway. In conclusion, the hammer pattern is a useful tool in financial markets, offering signals that can help traders identify potential reversals in market trends. Like all technical analysis tools, it is most effective when combined with other indicators and analysis techniques to make well-informed trading decisions. The Hammer Candlestick Pattern is recognized in technical analysis as a bullish reversal indicator, signaling that a stock may be nearing the bottom of a downtrend. This pattern is characterized by a small body at the upper end of the trading range, with a long lower shadow and little to no upper shadow. The long lower shadow, which should be at least twice the length of the body, signifies that sellers drove the prices down during the trading period, but by the close, buyers managed to push the prices back up, indicating strong buying interest. Visually, imagine staring at a candlestick chart where you notice a candle that looks like a hammer. This candle has a short body sitting at the top with a long wick stretching downward. The body, representing the difference between the opening and closing prices for that time period, is small. Meanwhile, the long wick or shadow tells us that at one point the price dropped significantly but then recovered substantially by the period's end. The absence of a significant wick above the body emphasizes that the recovery was strong, suggesting a potential swing in sentiment from bearish to bullish. To provide a hypothetical scenario without actual images, let's visualize a chart where after a series of declines indicating a downward trend, you encounter a candle with these hammer-like features. This candle forms at a price level that coincides with previous support levels or other technical indicators, enhancing its significance as a potential harbinger of a trend reversal. Observing such a pattern, traders might view it as an opportunity to consider entering long positions, expecting that the trend could reverse in favor of rising prices. Understanding and identifying the hammer pattern involves not just recognizing its shape, but also interpreting its context within prevailing market trends. Correctly identified, the hammer can be a valuable tool for investors and traders looking to capitalize on shifts in market sentiment. Identifying a hammer in the financial markets involves recognizing several key features that exemplify this bullish reversal pattern. The shape of a hammer is perhaps its most defining characteristic. It resembles the tool it is named after, with a short body and a long lower wick. The body of the candlestick is at the upper end of the trading range, indicating that the closing price was near the high of the day. In contrast, the long lower wick signifies that the price plunged during the session, but then pulled back to close near the high, suggesting a rejection of lower prices. The size of the hammer's body can vary, but it is generally small compared to the length of the lower wick. The wick should be at least twice the length of the body, which highlights the significant recovery from the session's lows. The color of the hammer may be green or red. A green or white hammer indicates that the closing price was higher than the opening price, which might be seen as a more bullish sign than a red or black hammer, where the close is lower than the open. Nonetheless, both colors are considered to have bullish implications within the right context. The pattern's position within a trend is crucial to its interpretation. A hammer is considered a bullish reversal pattern and thus needs to occur after a downtrend. Seeing a hammer after a period of declining prices suggests that the bearish momentum is weakening and could be about to reverse. Spotting a hammer in an uptrend does not have the same significance and may not indicate a reversal. For a real-world example, imagine looking at a stock chart after several weeks of declining prices. If you observe a candlestick with a small body at the top and a long lower wick, that could be a hammer. To confirm its potential bullish reversal signal, you would look for this pattern to be followed by a price increase in the subsequent days, indicating buyers are starting to take control. As we cannot display actual chart examples in this format, visualize a chart where a hammer pattern forms after a sequence of red candlesticks indicating a downtrend. The emergence of a hammer signals to traders that it might be time to consider looking for entry points to buy, expecting the trend to reverse and prices to start rising. Understanding and identifying hammers can help traders make informed decisions, but it is essential to remember that no single pattern guarantees market movements. Always consider using hammers in conjunction with other technical indicators and analysis to validate potential trading opportunities. The hammer is a technical analysis chart pattern that signals a potential bullish reversal. This pattern is especially significant when it appears after a downtrend, suggesting a possible shift in market sentiment from bearish to bullish. The structure of the hammer, characterized by a small body at the top and a long lower wick, visually represents the trading activity within a specific period. At the opening of the trading period, prices may begin to fall, a continuation of the bearish sentiment. However, as the period progresses, the selling pressure is met with significant buying interest, pushing the prices back up. The session closes near its opening level, thus forming the small body and long lower shadow of the hammer pattern. This price action reveals that, despite early selling pressure, buyers have started to gain control, indicating decreasing bearish sentiment and increasing bullish sentiment. The long lower shadow of the hammer demonstrates that buyers are willing to buy at lower prices and are able to absorb selling pressure, a behavior that could potentially reverse the prevailing downtrend. Traders interpret the emergence of the hammer pattern as a sign that the market's sentiment is changing. It suggests that the sellers, who previously had the upper hand, are losing their grip and the buyers are starting to dominate, which might lead to a reversal in the trend. In summary, the hammer pattern highlights a battle between buyers and sellers, where the buyers are beginning to take control, suggesting a shift in trader behavior from a dominance of selling to a willingness to buy. This pattern is considered by traders as a sign that the bearish trend may be nearing its end, and a bullish trend could soon begin, thereby influencing their trading decisions and strategies. The hammer is a candlestick pattern recognized by its small body and long lower wick, typically indicating a potential reversal in a downtrend. To determine whether it serves as a sign of trend continuation or a reversal, it is crucial to consider the pattern within the broader market context. When encountered after a series of declining prices, a hammer can signal that selling pressure is diminishing and a bottom may be near, suggesting a possible reversal to an upward trend. For instance, imagine a scenario where the market has been in a prolonged downtrend. A hammer appears, characterized by its small body at the top with a long lower wick, which suggests that although the price dipped significantly during the session, it closed near its opening price, thereby indicating strong buying pressure at lower levels. This could be a sign that the market sentiment is shifting, potentially leading to a trend reversal. Conversely, without a preceding downtrend, the significance of a hammer is less clear, and it may not necessarily indicate a forthcoming reversal. The surrounding market context, such as preceding price movements and volume, plays a critical role in interpreting the hammer. Additionally, confirmation in the form of a bullish candlestick the following day or other indicators aligning with a reversal prediction can bolster the credibility of the hammer as a reversal signal. For instance, in a chart following a significant downtrend, a hammer followed by a large green candlestick with high volume would reinforce the likelihood of a reversal. In contrast, if the market continues to show downward movement following a hammer, the pattern might have been a false signal or simply a minor pause in the ongoing trend. Therefore, while the hammer can often indicate a potential reversal following a downtrend, its reliability improves when combined with other indicators and a thorough analysis of market context. It is the merging of these signals that enables traders and analysts to make more informed decisions, acknowledging that no single indicator should be used in isolation. Understanding the hammer pattern in trading can offer valuable insights into potential market reversals. A hammer is a bullish reversal pattern typically seen at the bottom of a downtrend. It is characterized by a small real body at the upper end of the trading range with a long lower shadow and little to no upper shadow. This pattern signifies that, although selling pressure was present during the trading period, buyers managed to push the prices back up, closing near the high. There are several additional factors and conditions that can confirm or weaken the significance of a hammer, enhancing its reliability as a bullish signal. One key factor is trading volume. An increase in volume on the day the hammer appears adds credibility to the pattern. High volume suggests strong buying interest, confirming that the market sentiment might be shifting from bearish to bullish. Another important condition is the presence of nearby support levels. If the hammer forms near a known support level, its significance as a bullish signal is increased. Support levels are prices at which a significant number of buyers have entered the market in the past, potentially providing a floor for the price. The trend preceding the pattern also plays a crucial role. While the hammer is considered a reversal pattern, its prediction of a bullish reversal is more reliable when it follows a clear, sustained downtrend. The logic is straightforward. For a reversal to occur, there must first be a trend to reverse. In summary, while a hammer pattern by itself can be a useful signal of potential market reversal, its reliability is significantly enhanced by additional factors. An increase in trading volume on the day the hammer appears, its formation near a known support level, and its occurrence after a clear downtrend, and all serve to confirm the bullish implications of the hammer. Conversely, the absence of these conditions could weaken the pattern's significance, making it less reliable as a predictor of market direction. The hammer is a bullish reversal pattern that signals a potential turnaround in a downward trending market. It is characterized by a small real body, a long lower shadow, and little to no upper shadow. The long lower shadow indicates that, despite selling pressure during the trading session, buyers were able to push the price back up, closing near the open. This suggests a shifting momentum from sellers to buyers. Historically, the hammer pattern has shown a degree of accuracy in forecasting a reversal in market direction. This accuracy stems from its ability to capture a moment in market sentiment where the balance shifts from bearish to bullish. However, like all technical analysis tools, the hammer is not infallible. Its reliability can be influenced by market conditions and the context in which it appears. For instance, a hammer forming after a short-term pullback in an overall uptrend may not be as significant as one forming after a prolonged downtrend. Despite its potential to signal a change in market direction, it is crucial to recognize the limitations of the hammer pattern. Reliance on this single indicator without considering the broader market context can lead to misguided conclusions. For a more robust analysis, it is advisable to use the hammer in conjunction with other technical indicators and analysis methods. Confirmatory signals such as a subsequent bullish candlestick, increasing trading volume on the day the hammer forms, or technical indicators pointing towards a momentum shift can enhance the reliability of the hammer as a predictive tool. In summary, while the hammer pattern can be a useful indicator of a potential bullish reversal, it should not be used in isolation. A comprehensive analysis that includes multiple indicators and considers the overall market environment is essential for making informed trading decisions. Integrating the hammer pattern with other technical analysis tools such as the Relative Strength Index (RSI), Moving Average Convergence Divergence (MACD), or Fibonacci retracement levels can provide a more holistic view of the market and lead to more informed trading decisions. Here is how each tool can complement the hammer pattern. 1. Combining the hammer with RSI. The Relative Strength Index is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions. When a hammer pattern appears and the RSI indicates an oversold condition, typically a reading below 30, it suggests a strong potential for a bullish reversal. This combination can signal traders that the market might be turning upwards. 2. Integrating the hammer with MACD. The Moving Average Convergence Divergence is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. If the hammer pattern forms during a downtrend and the MACD starts to move from negative to positive, or the MACD lines cross in an upward direction, this convergence signals a possible bullish reversal. It indicates that the bearish momentum is waning and the bullish momentum is gaining strength. 3. Combining the hammer with Fibonacci retracement levels. Fibonacci retracement levels are horizontal lines that indicate where support and resistance are likely to occur. They are based on Fibonacci numbers. If a hammer pattern appears near a key Fibonacci retracement level, for instance, the or percent levels following a significant downtrend, it can act as a strong indication that the price might start to bounce back upwards from these levels of support. Example: imagine a stock that has been in a strong downtrend shows a hammer pattern at a significant level of support. If at the same time the RSI reads below 30, suggesting the stock is oversold, and the MACD indicates a positive crossover, this cluster of bullish signals can significantly increase the confidence in a bullish reversal. Therefore, traders might view this as a strong buy signal, expecting the price to rise in the near future. By using these tools in concert with the hammer pattern, traders can validate their analysis with multiple data points, thereby reducing risk and increasing the chances of successful trades. Through this holistic approach, combining pattern recognition with momentum and support/resistance level identification, traders can make more informed and confident decisions. Common mistakes and misconceptions traders have regarding the hammer pattern include misidentifying the pattern due to a lack of confirmation and overlooking the market context in which it appears. Some traders might jump to conclusions upon seeing a candlestick that resembles a hammer without waiting for subsequent candles to confirm the bullish reversal. It is crucial to observe the next candlesticks to confirm the pattern indeed indicates a reversal. Additionally, ignoring the broader market trend can lead to misconceptions about the strength and reliability of the hammer pattern. A hammer pattern that forms during a downtrend is typically more significant than one that appears in a non-trending or sideways market. To avoid these mistakes and enhance pattern recognition and analysis skills, traders should: 1. Wait for confirmation. After spotting a hammer pattern, wait for the next 1 or 2 candlesticks to confirm the reversal. Ideally, these candlesticks should close higher than the hammer's closing price, offering stronger confirmation of a shift in market sentiment. 2. Consider the market context. Evaluating the hammer pattern within the context of the current market trend can provide valuable insights. A hammer that appears after a prolonged downtrend may be more meaningful as it suggests a potential bottoming out and a turnaround in buyer sentiment. 3. Analyze volume. Volume plays a significant role in confirming the hammer pattern. An increase in volume on the day the hammer pattern forms can serve as further confirmation that buyers are returning to the market, making the potential for reversal more likely. 4. Use other technical indicators. Incorporating additional technical analysis, tools, and indicators can provide further evidence of a bullish reversal. For instance, if a hammer pattern forms at a key support level or coincides with an oversold reading on a momentum oscillator like the Relative Strength Index (RSI, this can reinforce the likelihood of a reversal. By paying attention to these details, traders can become more adept at identifying true hammer patterns and making informed decisions based on a comprehensive analysis of market conditions. The hammer is a candlestick pattern recognized in financial markets as a bullish reversal signal, indicating potential upward momentum. It typically appears at the bottom of a downtrend, and its primary characteristics include a small body at the upper end of the trading range, with a long lower shadow that is at least twice the length of the body and little to no upper shadow. Utilizing the hammer for making trading decisions involves careful consideration of entry and exit points, grounded in both the pattern's implications and broader market context. In terms of strategy, once a trader identifies a hammer pattern, it is prudent to await further confirmation before committing to a trade. This confirmation could come in the form of a closing price on the following day that is higher than the hammer's closing or an additional bullish candlestick. Setting entry points involves buying into the market upon receiving adequate confirmation that the downward trend is reversing. As for exit points, traders often set a stop loss just below the hammer's low, as a fall below this point may indicate the reversal signal was false. Profit targets may vary based on the trader's risk tolerance and the strength of the prevailing market trend. An illustrative story involves a trader named Alex who observed a hammer pattern form on the daily chart of a stock that had been in a prolonged downtrend. Recognizing the reversal potential, Alex waited for the next day's trading session, which manifested a robust bullish candle. This was the confirmation Alex needed. He entered a long position early in the trading day. Implementing his strategy, Alex placed his stop loss just below the low of the hammer to protect against significant losses if the trend did not reverse as anticipated. As the uptrend took hold, Alex monitored the stock's movement, setting up a trailing stop to maximize gains. Eventually, the stock's price reached a resistance level that had been identified beforehand, and Alex decided to exit the position, securing a profitable trade. Through meticulous analysis and strategic planning, Alex and other traders like him who successfully leverage the hammer pattern embody the thoughtful integration of candlestick patterns into broader trading strategies. Their stories highlight the efficacy of combining pattern recognition with sound risk management and the importance of waiting for confirmatory signals to mitigate potential risks. The hammer pattern is a significant indicator in market analysis, signaling a potential reversal from a downtrend to an uptrend. It is characterized by a small body at the top with a long lower wick and little to no upper wick, resembling a hammer. This pattern suggests that even though selling pressure was present by the end of the period, buyers were able to push the prices back up, hinting at a forthcoming bullish market. Several variations and similar patterns to the hammer exist, each with unique implications for market analysis. Inverted hammer. This variation looks like the hammer turned upside down. It has a small body at the bottom, a long upper wick, and little to no lower wick. The inverted hammer appears during a downtrend and signals a potential reversal or increase in buying interest. Its long upper wick indicates that buyers attempted to push the price up, but selling pressure still managed to bring it down close to the opening level by the close. Shooting star. The shooting star is the opposite of the hammer and indicates a potential bearish reversal. It occurs after an uptrend and features a small body at the bottom with a long upper wick. This pattern suggests that selling pressure is starting to outweigh buying pressure, potentially leading to a price decline. Hanging man. This pattern is identical in appearance to the hammer, but occurs at the end of an uptrend rather than a downtrend. The hanging man indicates that selling pressure is starting to surface. Despite buyers pushing the price up during the period, the selling pressure was significant enough to pull it back down, suggesting a potential reversal to a downtrend. To visualize these patterns in action, imagine the price charts where each of these patterns occurs. For the hammer and the inverted hammer, you'd look for them at the bottom of a downtrend. They would appear as a small block near the high of the day with a long line stretching down for the hammer or up for the inverted hammer, indicating significant buying or selling efforts that could not be sustained. Conversely, the shooting star and hanging man would appear at the top of an uptrend, showing small blocks near the low of the day with long lines extending up, signaling increased selling pressure or buying fatigue. Understanding these patterns and their variations is crucial for market analysis, as they provide insights into the psychological dynamics between buyers and sellers and can help forecast potential changes in market direction.